Let me start with a simple question. What if I told you for the last 20 years we might not be measuring the Indian economy's GDP numbers and growth rates correctly? Not that Indian economy didn't grow. It did. But the speed at which it grew may have been misunderstood. A new research paper by economists including Arvind Subramanian has reignited a debate about India's GDP numbers. And their conclusion is quite interesting. That's the best word that I can tell you. They say that India's economic story over the last 2 decades may actually be very different from what the official numbers suggest. Now, according to the study, India's growth between 2005 and 2011, the years of the big economic boom, may actually have been underestimated. But the growth between 2012 and 2023 may have been overestimated. In other words, the economy may have grown faster during the boom years but slower during the last decade than the official data shows. Now the question is, how could this happen? To understand that, we need to look at a unique feature of the Indian economy, the informal sector. Almost about 44% of India's economy comes from small businesses and informal activities, things like the neighborhood shops, small manufacturers, local service providers, repair shops, or small family enterprises. The challenge is that it's very difficult to collect accurate data from millions of such small businesses. So, statisticians often estimate the growth of this informal sector by looking at the formal corporate sector, that is, the large registered companies, and assuming that the smaller businesses are growing at roughly the same pace. But this assumption may not have worked in the last decade, and the reason I'm just about to tell you. Think about what happened to the economy after 2015. We had demonetization in 2016, the rollout of GST, and then the COVID pandemic. These shocks affected the economy unevenly. Large corporations were better equipped to recover quickly, but many smaller, informal businesses struggled, and some even shut down. Yet the GDP calculation continued to assume that the informal sector was growing at the same pace as the formal sector. And that may have inflated the growth numbers. There's another technical issue as well. How economists adjust for inflation. To calculate real economic growth, we need to subtract inflation from nominal output. In India's case, many sectors rely on wholesale price index, which tracks commodity prices like oil and many other commodities. But the consumers experience inflation through a consumer price index, which is always higher, and which was always higher even during this period. When inflation is underestimated, real growth numbers can appear to be artificially higher. Now, here is where the puzzle becomes obvious to many economists. After 2011, several key economic indicators and metrics began slowing down. Exports, bank credit growth, industrial production, and even electricity consumption. But the GDP growth numbers did not show any slowdown. For example, bank credit growth fell dramatically from 15% annually during the boom years to about 5% afterwards. So economists began asking a simple question. If so many indicators are slowing, how can the economy still be growing so fast? So, using alternative methods, the researchers estimate that Indian economy may have grown around 4 to 4.5% annually between 2011 to 2023 instead of roughly 6% growth as shown in the official data. Now, if that estimate is correct, the actual size of Indian economy today could be about 22% smaller than the official figures suggest. Now, this of course doesn't mean that Indian economy is weak. It simply means that measuring economic activity, especially in a country with large informal sector, is an incredibly complex work. An accurate measurement matters because governments rely on GDP numbers to design policies. Central banks use them to set interest rates. Businesses use them to decide investments. If the data gives an overly optimistic picture, policymakers might underestimate economic challenges. The broader lesson here is fascinating. Economics is not just about growth, it is about how we measure growth. And sometimes improving the way we measure the economy can completely change the story that we tell about it. Thank you. If you have enjoyed this episode, please like, share, and subscribe to this channel. Thank you. See you in another episode. Till then, bye bye.